Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Got a little cold there. I normally get a cold, starts in December and ends in March, and I think a lot of people think, oh, he's got COVID. And not really. I can kind of tell the difference, especially since I was a long hauler. I did have it for an extremely long time period, and boy, that was miserable. I would not want that to happen to anybody I know, even my people that I don't like that well. But anyway, which are very, very few. Yep. So if you're new to listening to this, you're just kind of channel surfing and suddenly came across this. My name is Bill Bullington. I'm here every Saturday morning from 11 to noon. I am the managing partner of Bullington Capital. It's a registered investment advisory firm and located in Fairlawn, right off of 77. I mean, I literally can walk out in the parking lot and see I-77. It's off of Route 18 and very easy to get to. If you hear anything here on this show that you'd like more information on, please feel free to go to my website. It's bullingtoncapital.com. And you can, there's a contact us form there. I'd be glad to try to get back to you as quickly as I possibly can. And so I've been doing this for an incredibly long time period. And I'm amazed, I guess, at some of the changes. Actually, the thing I think that amazes me the most is that if you can think of an investment strategy, back in the day when I first started, there were, I think 1,500 mutual funds. And I think on the New York Stock Exchange, there were 10,000 listed securities listed. Yeah. And now there's like a little over 3,000 stocks that are actually big enough to go into a mutual fund or an exchange traded fund. And there are 6,000 or 7,000 ETFs, nearly twice as many. And if you add all the actively managed mutual funds out there, it's significantly greater. Oh, by the way, I forgot at 11:20, I'm going to have Bob Klingman back on. He's an enrolled agent, tax preparer. We're going to be talking a little bit about RMDs, which have changed dramatically. So he's going to kind of go through the highlights there, what you can and can't do, what you should probably be what you should be aware of. And so stay tuned for that. And Bob will give you his phone number if you're looking for a tax preparer. He's a good one. I've been referring people to him for years, and very, very thorough, which is one of the things I really like about him. So anyway. And again, if you have questions, now I forgot my laptop today. So I'm actually sitting here staring at the microphone and just kind of rambling on, which is kind of what I do a lot of anyway. I do have my cell phone, thank goodness, and got the Wall Street Journal pulled up and looking at some different things that are going on, and mostly more of the same of what you've heard over the past few months. The big drivers, though, I mean, if you're looking at two things I think that are going to offer better long-term returns. The fixed indexed annuities I think they're going to offer a better return than most people will do on their fixed income. And they'll do a lot better than a lot of people will do on their stock investments, because I see that often where people are they're in the right funds, but they panic and they get out, particularly in 401k plans, because there's nobody there really to kind of coach you on the 401k. Yeah, you can log in and get a bunch of stuff from somebody. You should be able to talk to somebody. Some of them offer that service. Most of them do not. But when the average person is left to their own devices, it's really scary. The news is basically oriented to negative news. Why? Because psychologically that gets more attention than positive news does. And the news, one of their jobs is to sell ads. And if you're not reading the articles, you're not seeing the ads. So they're going to go with those things that are the easiest way to get your attention. And the easiest way to get your attention is to try to scare you. And, there's a lot of bad stuff. There's a lot of good stuff that goes on in this world. It just blows my mind how much. When you think about it, there are 3,000, a little over 3,000, not a ton over, but 3,000 companies big enough to be included in the stock indexes that are publicly traded. Okay. So a little over 3,000. Now, the Russell 3000, it's going to make up 99.5% of that. And to get into that group, you have to have an enormous amount of sales. You have to have an enormous amount of employees. And just those two items by themselves, I mean, it's outrageous to me how much money is involved in that, but it's also very comforting because that money's not going to go anywhere. Those companies are going to, there will be lots of changes, by the way. Some of them will go away. Some of them will get bought out, and some of them are going to merge with other companies, and then you're going to have new companies coming around. The new companies coming around over the next 5 or 10 years, probably going to be related somehow to the grid, electricity. I know you hear me talk about that, and you're probably a little tired of it because most people get tired of something, probably about 30% of the way through till it actually arrives. And I can't tell you how long I talked about electric cars and this company called Tesla, and people are going, what? Who? And I'm going, just wait, you'll see. And now everybody's like, oh yeah, well, anybody could say, yeah, well, go back and listen to my radio shows from the early 2000s before that, those companies even existed. Okay. So, and it's not magic. I mean, it's, I like what I do. That's what it is. And I read a lot. So, and, what's really kind of nice for me today is anything out there worth watching or worth reading, there's probably a YouTube video on it. I mean, it's unbelievable how many videos, and it's in the millions that get produced every day. Okay. And every major news source will rebroadcast their stuff online, stuff that you are paying good money for to get in your cable subscription. That's probably also available on YouTube. They have a tendency to delay it a little bit so that the people who are paying get it first. But it's really amazing to me to see how much information is available there. And not just YouTube, but the Energy Information Agency, EIA, they're online. There's a ton of schools that Massachusetts Institute of Technology, it's got a website. A lot of the California leading edge technology companies have their own websites, and they publish and they put out information just to kind of let you know what they're working on. And it's good PR. It's actually excellent PR. I think I read the Steve Jobs authorized biography. It was only like 700 pages. It was a lot. That was a big book. So was Warren Buffett's, by the way. But but Steve Jobs, he used to call, I forget the name of the guy, but he was a journalist, one of the top journalists in the country, worked for one of the most popular magazines, and they were also providing information for newscasts and whatnot. But anyway, he would call this guy every Sunday night. Every Sunday night, he'd call him and talk to him about what was going on. Now, and the guy's wife eventually got upset because the guy knew that he should probably stick around because Steve Jobs is going to give him some information that he's probably not giving to other people, at least not yet. And so I just thought it was kind of funny. But yeah, it's amazing if you have time, what you can find out, especially if it's publicly traded now. I've got this service, it's called Y-Charts, and you can go look up their financial statements, and it goes back 20 or 30 years. It's mind-boggling. And it's the actual information that gets filed with the SEC. Why is that important? Well, because they have guidelines, and a lot of the stuff that they publish, if you look down in the fine print, it will say, they've modified the data to make it clearer or whatever, because they feel like the format that they have to submit it to the government in sometimes could be potentially misleading. So can reinterpreting it, by the way. So you got to have to kind of watch, but I like the fact that you can see it as it's reported. That's pretty good. I should charge these guys for the plug, by the way. You can actually get it as an individual. It's kind of expensive. They have a cheaper version. If you just want to look a company up, it's a lot less money. So you just type in the symbol, and it'll show you all the financial statements on the companies going back, I don't know, probably 20 years or longer. It depends on how long that company's been around, too, incidentally. But in today's age, it's interesting to see all this happen. I really like the ability to be able to stay up to date a lot easier. It wouldn't be easy if I weren't doing this, for a living. It would be incredibly. It's just a lot of information to try to keep up with. There's just a lot, and it's changing. I mean, that's the part that gets me. I mean, I think a lot of times they're changing just for the sake of change. And somebody in the marketing department said, you know what? We need to reorganize this whole thing. And suddenly you go to the website and it doesn't look like it used to. It doesn't work like it used to. It's all different. Yep, that's the modern day. Don't worry about it. It's kind of like when I was growing up. And I'll never forget my sixth grade. I think it was sixth grade. Yep, my sixth grade science teacher. And it's Mr. White. And he was always teaching us all this stuff. And it was amazing how much in that class applies to the stock market today. And he was teaching us the scientific testing processes, and how you would write down what you thought might happen, and then you designed a test to make sure that what you thought would happen actually did happen. And when it didn't happen, you rewrote the test and tried it again. And I raised my hand. I was like, that sounds an awful lot like trial and error. And he just laughed. He said, well, it kind of is. It's the scientific method. But see, they have to put a 3-syllable word in there to make it sound important. And it is. I mean, it is. I forget how many times, I don't know, Bell tested a light bulb before he got one to work, but it was over 1,000 times. I mean, talk about having diligence. Holy cow. And patience. And, I wonder who supported him during that time period. It's like the guy that invented the, the vacuums. My mind is going, don't get old, people. But there are these vacuums they're very modern, they're very popular, actually. I think I own a couple of them. Anyway, the designer is a billionaire. He's from England, was an engineer, and it took him 5 years to build his first working prototype. 5 years. I can't believe he stayed married. Because, yes, he was married. But I didn't have kids, though. But 5 years, that's a lot of diligence. And I look around and I see how far we've come just during my lifetime, and we've got a long way to go. I mean, the grid's going to have to be redone from, not from scratch, but an awful large portion of it is going to have to be replaced. The demand is continuously increasing a little bit faster than the population growth. Figure that one out. Why are we using more electricity per person than we used to? But, you know, the jobs that creates are astounding. I mean, it's unbelievable to have that as a background or a backstop or whatever you want to call it. But it's not going to stop. And when you think about all the things that you use electricity for, that's just not going to stop. And they've got to use wind, and they have to use solar, and they have to use natural gas, and they have to use coal. They need to pay attention to doing it clean. Cleaning the coal up, is expensive. So but they still need to do it, because you just can't handle all the capacity or the necessary capacity with just one or two of those items. So it's everything. What does that mean? It means jobs. It means good paying jobs. It means that the economic future can only be messed up, and it will be. I mean, the politicians get involved and it slows everything down. But, that's normal. That's basically how we got this far. And that's how we're going to continue to go. But I've looked into the future and I feel really optimistic. There are more projects than we can actually handle, at least if you try to handle them all at once. And they're big projects, and they're going to make up a larger and larger portion of the overall economy. And when people are working and getting paid, they buy shoes, they buy groceries, they live in housing, they drive cars, all that stuff. Everything grows, everything benefits. So what's my point behind all this? Well, since I have about 15 seconds or so before I have to go to commercial break, I guess we'll have to wait until I come back before I can talk about that. But the benefit of all this stuff, it benefits everybody. I mean, it really does. It's not that it's not risky or risk-free. There's a lot of volatility involved. We'll talk about that in just a few minutes. It's Bill Bullington right here on 1420. Stay tuned. All right, I'm back, and I've got Bob Klingman on the line. Bob, are you there?
Yes, I am.
Thanks for holding on there for a couple minutes. Bob is an enrolled agent, and he came up graciously on last week's show, and we're going to have him. We're having him back here today. If you have a question for Bob, you can always call us 216-901-0945. That's here in the station. Or you can actually email me, bill@bullingtoncapital.com, and I can forward it to him. Or, Bob, why don't you give out your email address?
My email address is dispatchtax@AOL.com. I still have AOL.
Okay, that's cool. That takes me back. Dispatch tax, yeah. Dispatch tax at AOL. So if you have a question, you hear something here. And we were going to talk a little bit today about the Secure Act. And the only thing I think that's really secure about this is that it's very difficult to understand, and that's pretty secure.
Oh, absolutely. Yeah, things will change.
Yes, the changes here. It's amazing to me. But anyway, so I just thought I would ask you what you think the most important changes are for the average person. If you want to think about that, that's fine. But I'm just looking at the individuals that were required to start taking RMDs, and they've pushed that back now. They
have back. I was thinking about that too. It's now going to be 73 for this year. The starting age is for this year. It's gone from 72 to 73. And then they're pushing that back out to, in 2033, it will be 75. So,
Wow.
I started thinking about that, and I'm thinking, boy, I'm 65 now. I think more they keep pushing it out, so, you just keep, I don't know, they keep pushing it out there.
Which is really funny. The average life expectancy in America is just a little over 70 years.
So they're pushing that out. And then that brings me to the point that how the market's been last year.
Right.
And, they keep saying as you get older, you have to modify your investments. Are you going to be in stocks? You're going to be in bonds? But
Right.
I'm planning on, I planned several years ago to be in for 10 years.
Right.
And then I had to take it out. Well, now they pushed it back.
Right.
At what point do I jump in and I change, or do I just leave it go? That's where you come in.
Yeah. And that really, for us, has always been kind of a function of, we're going to take a look at how old you are, whether you're required to take money out, and what is your risk tolerance, because that's the key factor
Right.
there. When I get people, I've seen it my entire career. People come in, they're pretty gung ho, and then when the market's down 15 or 20%, they're scared and they go back to cash, and they don't understand that they're trying to time the market. And they'll argue with it, but that is the actual definition of market timing. I'm going to get out when it starts going down, and I'm going to get back in when it starts going up. Well, if it were that easy,
Right.
nobody would ever have to work, ever.
Right. And I think and I've seen it personally myself, that the market's a roller coaster. When it goes down, it will come back up. And as you said, there's no timing that, So I know people that have gotten out and said, boy, I should have never gotten out because I got back in. So that's, it's hard. It's very difficult to trust. It really is.
Yeah. So this is, and this is one of the reasons, especially when you've got taxable accounts. Holy cow! You want to talk about, adding fuel to the fire? You got to do all that accounting. You may end up paying capital gains taxes on stuff you sold, on top of the fact that it's actually worth less, and then you're going to generate taxes. So really important. And here's the key question for everybody. I've been doing this for over 30 years. I still haven't found a questionnaire that nails somebody's risk tolerance down as close as this one question does. And the question is, how much of a decline do you think you could stand to go through? And that should guide all of your actions. So I'll make it easy for you. If I have, let's say I have a 30% decline tolerance, okay, because I'm still working. I got another 10 years easy. And my job is, the hardest thing about my job is getting up and walking around and getting some exercise.
Yeah.
It mentally, it's pretty difficult. But
I was asked that question back, and I think I said, I didn't say like you did. My answer was, when I was answering the gentleman, I said 10 to 15%. He says, that's nuts. I go, well, that's what I want to. And then he says, he's talking more along the lines like you said, 30. And as I got the years forward now,
right,
in this past market, I'm looking at from 2022.
Right.
Okay, I will take the 30 because I'm only down about 10, 15%.
Right.
But you have to look at what did it go up in 20 and 21.
Yeah. Yep.
Okay.
Right.
So, like you said, it's hard. It's hard to stand there while it's doing that.
Oh, it is. That is one of the toughest things to all of investing, is when you're going through the corrections, and that's what my number one job, at least I feel it is to explain. Listen, yeah, I've got in a portfolio. The best performing portfolio over the past 10 years has been the one that's 100% in stock. Okay, that's the best performer, but it's been down. That strategy's been down over 40% at least twice in the last 10 or 20 years. So if you can't take, you might not even be able to afford to take that kind of risk. That's what gets really spooky.
And you hit the nail right on the head right there. You know, it's a matter of age and timing, and can you afford it? Do you need the money now?
Right.
And that is the question.
Yep.
Do you need the money now? And if you do, well, then your risk tolerance is going to be a lot less.
Oh, you got to have that in a money market account. I mean, that's if you need the money now, you should not be taking any risk with it. But
Absolutely.
hey, I got a phone call, and I think he has a question on RMDs, and I'm going to see if I can just push the button there to bring him on board. So, okay, and this is Bill, and you had a question on RMDs?
Yes, I do. The issue I had was this. Last year in late December, I took my IRA and put it into an annuity.
Okay.
Obviously, this year the annuities didn't make any money because everything was down. Both of the indexes that they were both down. Neither of them made any money. However, I turned 72 in September of last year.
Okay.
So I had to take
Right.
an RMD.
Right.
Okay. So here's the issue. Because of some things, where I was kind of following my investment agent from bank to bank, I didn't the RMD check, I still haven't gotten that yet.
Right.
So as I understand it, and I'm not sure, and that's why I said the question, I'm going to have to I have to take that RMD, and I'm under the impression that before the end of next year I have to do the same. Is that correct?
Okay. Do you still, is it in an IRA account?
It was, essentially, yes. I went into an indexed annuity.
Okay.
Okay, but there's a difference between an IRA and an annuity. Okay. The basic.
I think he's saying that he put the IRA into an annuity. Is that correct, Bill?
That's exactly what happened. That's exactly what I did.
Right.
Okay. I'm just trying to figure out if it's an annuity. Annuities, there's no RMDs on annuities, but there is on an IRA. So it's an IRA, yes, you do take an RMD.
I am required to take an RMD. I mean, I've already been told that by the insurance company. So I mean, I knew I had to take an RMD. But I guess the point I'm trying to say is, do I have the money that I am going to get is not income for last year, because technically it's income for this year.
Because it's when it's constructively received and gotten by you, which, Bill, we spoke about. Right. Bill and I had spoke about this before, because the timing of the RMDs need to be done earlier in the year, because it's time to process. That's part of the problem.
My maturity date was not until 22 December. So in other words, my first full year in the RMD, in the annuity was 1 year was the 22nd of December.
Correct. So you would have had the April 1st. Yes. So
okay, but April 1st of this year is when technically I could have waited till then.
Correct.
To take it, as I understand. But that would be the first year that I had. But I mean, next year I'll be 73, obviously.
You'll have to take
hopefully if I get there. But I'm curious. I'm going to have to take another RMD.
You do.
So in other words, technically 2 RMDs in the same year.
Right.
That's the question.
If you decided to wait until April 1st to make that distribution, yes, you would have 2 in the same year. I have a feeling that you may still, since you initiated the process in December, that you may be getting a 1099-R for the distribution that you did. Just be on the lookout for that.
Okay.
So that will be for 2022, and then you have another one that you have to do for 2023.
Okay.
You'll need to get that in.
I think I understand that,
Yeah,
but
yeah.
so in other words, what you're telling me is that this RMD, even though I won't receive the money until, because I haven't gotten it yet, so we're already into 2023.
Right.
As far as reporting income, which is what obviously the RMD is supposed to be, I will have to report income on 2022 or 2023, which would be next year, which means I would have to report 2 RMDs in 2023. Is that what I'm looking at?
It's possible that you might, because of the processing time that it takes. You may have initiated it, but they did not process it until 2023.
Okay.
Which is why Bill and I have spoken about this before, that you need to start the process early enough for them to do the processing.
Well, the issue was obviously that the my maturity date was not, when you sign a contract on these things. Now, I could take up to 10%, every year if that's what I wanted to do.
Right.
Correct.
However, the maturity date under which, and the reason, obviously, I wanted to leave it there as long as I could, just on the off chance that there was a 2 or 3%, hoping for at least a 2 or 3% dividend on that on the annuity.
Correct.
However, not having anything, it didn't make any difference. But the income itself, I won't get until this year, and so as a result, now I've set up to make sure that on the maturity date, on the maturity date, that's the date that they process the check.
And that's great.
So next
wonderful.
year, what will happen is I should get the check before the end of the year.
That is correct. I would just say to be on the lookout for that 1099-R for 2022, or you can consult your person and see if they are issuing you one for 2022. What year they're going to issue that for?
Okay. Well, like I said, I see. In my history, I'm a contractor, and I have. I've been dealing with 1099s most of my adult life.
Okay.
As a result of that, I understand. I understand 1099s and all that other stuff.
Right.
The thing about it is sometimes I don't even get the 1099s until after I file the income tax this year.
I am on the permanent extension program.
You may not see those.
You as well, huh?
Yeah. Oh, I get 1099, and they come after. Sometimes they come after the tax return's already due, so I just automatically, But
yeah,
absolutely.
Well, that's what I'm saying. So you understand.
Yep.
You understand my. Hopefully, y'all understand my question.
Yeah.
I guess I would question is.
I understand your question, and it's something that I see all the time, and it's a thing like you said. You really have to do your own footwork and find out from them when they're going to issue it, or before you file your taxes, at least wait till the end of February, beginning of March. And if you haven't.
Well, I try to wait till April, but
hey,
okay.
I'm waiting till October.
Okay, there you go.
Good for you. That's why God made extensions,
yes,
right?
Absolutely.
Right, absolutely. If you have
we got to take a real quick commercial break, guys. And Bill, thanks for calling. If you want to talk about it further, you can call either me or Bob. We'll give out the numbers again a little bit later. And Mark, thanks for hanging on. And we're going to take a real
thank.
quick.
I just want to tell you, I listen to you almost every Saturday.
Oh, I appreciate that. Thank you very much.
So,
Yeah. All right.
Thanks.
Well,
Okay. Thanks. Thanks for the information, fellas.
no problem.
Have a good day.
Thanks. You too.
If I had only known the last time would be the last time.
And we're back. Hey, Bob, you still there?
I am here.
Okay, I got another caller that wants to ask you a question, and he has been patiently waiting. And this is Mark. Mark, are you still there?
I'm still here.
Hey, so thanks for waiting. And you're on the Bullington Capital Report, and Bob Klingman's here, and I guess you had a question for him?
Yes. I have two investing accounts. One's an IRA and the other one's a taxable.
Okay.
Is there an advantage to different types of or disadvantages to different types of investments in different types of accounts, like a master limited partnership? Should I be keeping that in an IRA or should I be keeping that in a taxable account? Same with bonds or mutual funds or individual stocks or dividend stocks versus non-dividend stocks or ETFs and
Right.
or mutuals. Any advice on that?
Well, yeah.
Here and Bill.
Okay. You know what? In order to answer that question, you actually have to be able to predict the future with a relatively high degree of accuracy.
Okay. Which my crystal ball works as well as your crystal ball does.
Right. Exactly. So when
It reflects sunlight sometimes.
when I look at it, and I've heard both arguments. You want to put your or taxable ETFs into a Roth IRA because you're going to make more money, and the more money you make, the less money taxes you'll have to pay. Okay, but that means you're going to leave your bonds in taxable, and you're going to pay taxes on 100% of the income. Okay, so what if we put bonds in there and stocks that you don't, or ETFs that you're not going to sell right away, and with the idea that, well, you don't get a capital gain on a ETF until you sell it. A lot of them, not all of them, but the vast majority of them, they're very tax efficient. So, and it's going to grow faster. It'll be taxed at a lower rate. Okay, well, what happens if the market crashes and it's 10 years before you see any return?
Yeah, that's possible.
Yeah, so I've only lived through that twice in my lifetime. But 2 10-year time periods with negative returns are that's pretty rough. So
hard on your intestinal, your innards, yes.
Yeah. So I'm going to tell you what I do. I run all my investment accounts, my taxable and my tax deferred, the same. I have stocks, ETFs, and bonds, bond funds mainly, in both accounts. And I try to keep them fairly balanced because overall, I'm looking at the asset allocation of all the assets, and it's easier to come in and use the same model in both and just pay the. Now I can hear people screaming. All the people that are screaming who put all their bonds in Roths because it's going to be taxable, they're screaming at me. All the people who put their stocks in Roths because it's going to make more money, they're all screaming. So I made everybody mad.
Going to make some people happy and some people mad.
Yeah. And but that's just how I like to do it. If I'm going to, with ETFs, they're very tax efficient to begin with. So, yeah, you could put more in there and then put the bonds in your Roth IRA, but the Roth IRA is going to be tax-free, and you'll be missing, in the long run, my stocks have done way better than the bonds have. I mean, it's not even close. Okay,
I have more stocks than bonds.
Yeah. So,
and it's a matter
what
of
about master limited partnerships? I was thinking of buying one or two of those, and I was just wondering if there's special tax considerations on those.
The master limited partnerships are basically, the only difference is that they pay, before all else, they pay the investors first. So that's where they get paid. That's where you get paid first. They were very popular about 5-6 years ago with the oil industry, especially the delivery system of the oil industry, and they do very well. But you have to remember that the gains on those or losses or anything like that cannot be taken until you dispose of them. So it doesn't mean you lose. If there's a loss within there, you don't lose it. It's just that when you sell it, that's when you make up on all these. Now, I had people that were in them for years, and they sold out about 3 years ago, and several of them had accumulated $20,000-$30,000 of not losses from the master limited partnership, but within the business itself. The business basically generates losses because they pay you first. So if they pay you first, there's nothing left, and it's basically a loss type business.
Right, they're
and
forwarding
you can't
losses.
claim those losses until you sell that master limited partnership.
I do listen to Bill frequently, and I do consider his advice very favorably. I basically have the same investments in both my IRA and my taxable account. So, and I do have more than one. I use his 1% rule and so forth. So, I do have plenty of diversity in it. So
that's good.
Very good.
It's good advice from him. So I was just wondering, if there was a tax advantage to holding a certain type in a specific type of accounts, and that was kind of was wondering about. So
by the way,
it's not a subject that most people talk about.
Right.
So.
And I've there's a reason for that. I've seen that the tax laws change dramatically on master limited partnerships at least 3 times in my career.
Yep.
And so you have to keep up on that because they are going to change from time to time. And
okay,
it's kind of that's one of the reasons I'm not a huge fan because it's so complicated and it takes so much effort, and they all have slightly different structures. They're not identical. And so you're going to end up reporting different things for different companies in different ways. And if it's in an IRA, you don't have to worry about it.
You don't.
So if you're just looking for the yield or the income, and just remember, though, I was invested in these a few years ago, and boy, they just got hit hard. I mean, really hard. And you could probably make it back up if you waited long enough. I waited until I got about a third of it back, and then I lost patience with it. But and I'm kind of glad I did because it worked. It worked out a lot better.
Well, now you know why I asked before I leap.
Yes, absolutely. Yeah, that's very intelligent.
Right.
Well, yeah, I try and do the right thing,
Yeah. Yep.
Doing your homework, right?
Right. Absolutely. Yep. Well, hey, thanks for calling, Mark. And if you've got any further questions, just you can reach me in the office or shoot me an email.
Super. Thank you very much. You've been very helpful.
Well, thank you. Have a good rest of the day. Boy. And I've got JR with a question for me.
Why, good afternoon, Professor. I have my question is one. What specifically is a federal 1099 form?
That's
federal 1099 is just a reporting form. Okay, you will see them. Your 1099-R. If you're retired, you will get that. That's for retirement. What about your interest from a bank? You may get it's a 1099 interest statement. So it's just a reporting of institutions that report income to you, whether it's taxable or not. That's what you have to determine. But the IRS does match them. That's the biggest thing they do right now is that, audits are way down because computers are taking care of things, and computers look, okay, we send out a 1099. Does that show up on your return? Is it in the proper spot? It has to be in the proper spot. So are you you get a 1099 INT, you putting it in the proper spot? Are you getting a miscellaneous? Are you putting it in the proper? That's the big thing.
Sure. So if I have all of my stocks, bonds, so forth and so on into a tax-free, I wouldn't be getting a 1099, would I?
From a tax-free?
Yeah.
You will get okay, now you have to understand, you will still get a consolidated, probably if it's within, an investing company or anything like that. You'll get a statement, and it will tell you how much on the thing, it will list on there. You'll still get a 1099. But people look for a 1099 INT. When you get them from an investment company, they're called 1099 consolidated statements. Within that statement is a 1099 INT, a 1099 DIV. They'll list any non-taxable. They'll list everything within there. So it's a reporting statement.
Right.
Understood. Okie doke. And then I do have one other question, if you have a moment. It's kind of complicated, but I have several businesses. One is a non-real estate business that is providing, I'm not getting anything out of it, but every year it provides a small amount of taxable income for me, which would be active, I believe. And I have a real estate company that provides passive income. Is there any way that I could use one to offset the other?
No. Passive income cannot offset business income. Passive is against passive, and business is against business income. Now, when you say passive, I assume that it's something like a...
Hey, guys, we got about 3 seconds, so we'll have to get off.
That's the bottom line, is that,
Very good. Thank you.
Yep, thank you. Yep. And, hey, you've been listening to Bill Bullington here every Saturday morning. Sorry to cut it so short, but we just ran out of time. Tune back in next week at 11 o'clock Saturday morning. Reach me on my website, bullingtoncapital.com. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.